All right, guys. Glad to see you all here today. It's March 2nd, 2021. I can't believe we already started tax season for a lot of us realtors, actually for everyone here. Tax day is April 15th, and I wanted to give you a class to really get you going as you start to prepare for our 2020 income taxes with the IRS. And I have to always start with a disclaimer that I am not a CPA or a certified tax professional. I am a real estate broker doing this for about 16 years now. So I'm going to be giving you some, tips and tricks and some ideas. And from my knowledge, how are we best as realtors in our business to report our taxes and our 1099 incomes and properly do this the right way from a broker perspective. This is from my knowledge, and been doing my own taxes for quite some time now. So I'm fairly familiar with the tax laws that apply to us as realtors. And the second disclaimer is that you take this as the purpose of this is to help you with the ideas, to help you with your planning so that you can go ahead and prepare the stuff and consult with your own tax professional, provide them the various receipts and the reasons and various things, because tax laws have changed significantly since the Tax Cut and Jobs Act several years ago. So for us as professionals, it was actually very favorable. There's a lot of good things in there to help real estate professionals, a lot of good ways to have increased standard deduction and all these different things that I'll cover in the materials. But I do always have to remind you that I'm not a certified CPA, so this is more for your preparedness to have that better conversation with your own accountant. You got it? So a lot of you guys, definitely have what's called taxable income. If you made any sales, and this is regarding 2020 or leases, you do get from our company a 1099 to report for your own taxes. And just an overview of what a 1099 miscellaneous income is. Really quickly, the 1099 is to be paid to independent contractors. You guys are all treated as sole proprietors from the IRS perspective. So we're all running our own business. Okay, so you are technically, in the eyes of the IRS, you're a business owner. And whether you have employees or not, you yourself are considered your own employee. You're working for your own business. And some of you guys do have assistants and or whatnot, or you guys have what's called a S corp or a C corporation or an LLC. And I'm not speaking towards S corps, C corps, or the LLC. Because you guys all, if you guys have created those entities, you probably already have your own accountant giving you guidance. I am speaking in today's lesson all towards a 1099 typical realtor who does business under their own name and have not set up an entity. Okay, we got that straight? So what is a 1099?
Yes.
That is your income that you receive. And as a company perspective, Coldwell Banker Dynasty, we treat all of you guys as independent contractors, and you're responsible for your own business and you're reporting for your own taxes. So that is something that's considered your duties as a business owner, is to report your own taxes and be truthful in how you report to the IRS. And ultimately, it's called the burden of proof. So you are also responsible from the IRS perspective as a business owner to provide and have evidence for all of the deductions and expenses that you make in the course of running your business. So because of that, and because of what I want to cover today, I'll be speaking only towards the Schedule C of your IRS federal tax return. And those of you who've been doing this for some time, you already know that your Schedule C is called your profit or loss from their business. And some of you guys have several businesses. Some of you guys might be running Uber, or some of you guys might be selling things on Amazon or online. And so I'm only covering the real estate portion of the Schedule C. So that is really applicable towards you guys, and some of you guys might even have W-2 income as well. So I'm only, again, speaking towards the real estate side of things because that's where you're here for, and that's where I have my experience to share with you. Got it? All right. So I'm glad you're all here. Some people are coming into the class, and I appreciate this because you guys are here to learn and ultimately how to really save on maximize your deductions and or pay less taxes, all in the course of doing what's right, what's appropriate, and what's truthful and accurate, and you have proper documentation. So with that given said, I thank you for hearing me out on the beginning portion. First of all, I wanted to share where I'm getting some of my resources from. So I will go ahead and start with sharing my screen. And I did find this page from the NAR website. It's under the new Tax Cut and Jobs Act from NAR. So this is what it really, how it's treated, and the new Tax Cut and Jobs Acts, the major changes from prior to 2017 and what's current law right now. Okay, so it's really good for those of us who are homeowners and those of us who are making real estate sales for real estate professionals. This article here really covers the gist summary of what we should know, so that way we can educate ourselves and our tax accountants who may challenge us on certain items, okay? Because a tax professional only wants to make deductions on what you have receipts for and this and that. And so you can click through the links on your own when you go through, and you can just type tax reform NAR and you'll be able to find this page. But ultimately, I just want to talk to you about what NAR had did, their efforts in making sure we save exclusions for capital gains for the sale of your home. And there's things like you still kept 1031 exchanges. That's something that has not changed as of now. There's other things for independent contractors or people who do pass-through businesses, which is a C Corp and S Corp. And you can significantly reduce the taxable liability that you're going to be responsible to pay taxes on. So ultimately, what I want to kind of cover is a basic summary. I'll give you some scenarios, and you can kind of apply it to your own situation. But at the end of the day, all of us have unique backgrounds, unique businesses, and different expenses and whatnot. So you have to take this for your own situation. Okay. So what I want to kind of talk about in detail is some of the differences and what happened previously versus what's going on now in terms of tax law for 2020 as we file for in April. So basically what we're trying to figure out here, and I'll speak towards what the primary things that we can educate some of our homeowners that we sell property to, and also apply all this news to ourselves. Okay, so there still remains what's called the exclusion on gains when you sell your principal residence. That has not changed. Okay, so just so you know, if you lived in your primary residence 2 out of the last 5 years, actually what it now says is, or 5 out of the past 8 years, this is basically allowing a single individual to exclude $250,000 in gains, or a married couple would be $500,000. And we all know since the past 5-8 years, homeowners have appreciated home appreciation. Okay, we have all seen and witnessed the gains and property values rising to the point where if you sold in 2020, you probably sold at a gain. If you bought the property 5 years ago, 10 years ago, even 20 years ago, practically 99% of the property owners have some considerable gains that technically would be taxable if you exceed 250 or 500,000 based if you're single or married. So therefore, this is one of the greatest benefits of home ownership. If you have gains, let's say you're a single person and your property was purchased for 400,000 many years ago, you reported it on your tax return as your primary residence, then you sell the property at to 650,000. All of that gains, 250,000 gains, there's no tax. That is a huge, huge benefit. Okay. And if you're married, then great. You can even have larger gains that are going to be excluded. This is not anything new, just letting you know and reminding you that this is what you should share to your homeowners to make sure that one of the compelling reasons why they should buy a home and occupy and report it as your principal residence. It is a huge benefit that you don't get if you decide to rent a property. So they're missing out on this potential gains. There is a significant change towards the mortgage interest deduction. And that's previously homeowners would be able to deduct all of the interest that they paid toward their mortgage lender. So whatever you paid towards the mortgage interest towards your lender, that would have been prior to 2017 completely deductible. But now this deductible mortgage debt applies to debt of $750,000 loans, and there's a cap. Okay, basically that cap is about $10,000 of mortgage interest deduction. So if you paid more than $10,000 mortgage interest to your lender, then you can only deduct up to $10,000. Okay, does that make sense? Now, if you, there is a difference, and just so you educate yourself, when you buy a new home, or when you buy a home, the first few years, majority of your monthly payments is going towards interest. Very few of that is going towards your principal. So the large set of it will apply towards the first few years. You might be paying, let's say you bought a $2 million home. A lot of that will be going towards the mortgage interest. And therefore, the first few years of your tax reporting, you probably are going to exceed the $10,000 mortgage interest deduction cap. Okay. But as the years go, and maybe the 4-year mark or the 5-year mark, at that point, then you'll probably only be paying, up to around you'll be reaching around that $10,000 cap. So that's calculated for you. Your mortgage lender will provide you a statement of how much you pay towards mortgage, and you get some sort of it's called a -INT, and they'll give you that form that you can apply easily and give to your tax provider, or go ahead and input it yourself if you do prepare your own taxes. Any questions on that mortgage interest? Now, there is also a cap of $10,000 that you can apply towards your state and local tax deductions for your property tax. So this is separate from your mortgage interest. And all of us, let's say you bought a property for, $700,000. And if the tax rate is 1.1%, you're roughly looking at a $7,700 annual property tax, correct? It's, most areas in LA County are 1.1 to 1.2%. And like, for example, El Monte, they have their tax at a 1.4% assessed tax rate. So if you happen to be to the 1.1 to 1.2% rate, $7,700 annually, you are under the $10,000 cap. So therefore, you could deduct your property taxes in full. The problem is for many people who have assessed values that are greater than $1 million. If you have a $2 million property and they assess you at a 1.1% rate, you're looking at roughly $22,000 to $24,000 of property tax. And the terrible part for those homeowners is they can only deduct 10,000 of that, and they have to pay the excess. There has been a reform or change for 2020 and 2021. I think there has been a fight from people in California and New York who have higher property taxes. And I think 2020 and 2021, there is an exclusion that allows to deduct more than that 10,000, but I'm not too clear on that. But I did share some news from our Congresswoman Judy Chu many years ago. She reported this when I attended one of her meetings. So I shared that email with you guys a long time ago, and Congresswoman Judy Chu was successful in getting some sort of temporary relief for high tax-paying states like California and New York. But that detail I don't have in front of me right now, but it is applicable in the tax reform. One of the other cool things that we have in place for us independent contractor realtors is a standard deduction. And the standard deduction, regardless if you made $100,000 or $10,000 in gross income, is that your standard deduction is $12,000 for a single individual or $24,000 for joint returns. So this standard deduction, it basically is a straight, right off the top, $12,000 standard deduction for independent contractors. So that's really cool. Well, that's something to reduce our taxable liability. And there is what's called, there's some repeal of personal exemptions. Prior to or previously, we would have some deductions for each dependent that we have. There's some child home tax credits and this and that. I'm not going to speak too much on that, but I'll just tell you that they did double the child tax credit from $2,000, which is doubled from previous to 2017. So as long as you got a dependent, you technically are getting a tax credit, and tax credits are the best because regardless if you have income or not, tax credits do apply. So, those of you who have many children, then you are going to get that benefit, and make sure you report them properly to your tax return. However, I just want to give you a caveat that if you have a divorced couple, only one of the divorced people can claim this child tax credit. And I have seen in various experiences in the past that there was one parent who tried to take the tax credit, and the second parent then tried to take the dependent tax credit. And guess what? It'll flag a IRS red flag. And probably, I think how it was treated from this is all hearsay, but the person who filed first was the one who got the tax credit, and the subsequent one got some sort of red flag. So if you happen to be a divorced couple, and I would advise you report your tax first or have a discussion who's going to claim that child tax credit. Okay. Now, there's a question from the group. Is this $12,000 for single and $24,000 off the top? Means that you use this deduction and then you take your expenses out. Basically, yes, it is from the top. I'll get into that portion when I show you a scenario. Okay. Now there's a medical expense deduction. So as independent contractors, we do not have what's called benefits for our employees because you realtors are not employees. You are independent contractors. So we do not like a government company or agency. We're not like a large corporation who helps you with medical expenses. Every agent, realtor, practically throughout the industry pays their own health insurance, or they have a spouse that has family coverage from their corporation or workplace. So I know some of you guys have a spouse who gets family medical, and that's great. Otherwise, if you're a single individual or a married couple like myself, me and my wife are both realtors and we pay our own health care, but we get to take those deductions and make this deduction against as an expense. Okay, it's a valid expense. And there's solutions too. I know that California in particular, the health cost of healthcare has been rising for many years to the point where it's ridiculous. And for those of you who don't have favorable terms with your health provider, private insurance, I do encourage you to check two resources. One would be Covered California. Covered California, when they have open enrollment, I think in November or December, and you can get really affordable health care with the government help through Covered California. That is what I use myself, and I really do like the options available, whether I want to go through Blue Shield or Anthem or Kaiser or choose whatever providers. I have choice, and I do have what's called a reasonable rates. The second resource is through NAR. NAR has lobbied for realtor healthcare for families and for individuals. And you can go to the NAR website. They have a link that you can go and apply for industry-wide coverage and compare for yourself to see which one is the most reasonable, affordable to your situation. Okay. So the other things that's major changes, I mean, I'm not going to talk about student loans or casualty losses. That's when you maybe had, and this is applying for 2020. Maybe you have a property or a home and you were in the wildfire area and in Zusa or Glendora or Sierra Madre and your house burned down. And if it happened to you, there is deductions and benefits that you can take care of regarding casualty losses. I'm terribly sorry if you were a victim of wildfire, because not only do you have a huge major loss, you had to find a place to move, but guess what? Your property insurance for all areas in wildfire areas have been ridiculously much more expensive to the tune of four to five times of what you paid last in the year prior. So everyone who are in a high fire severity zone are experiencing triple, quadruple, or five times the amount of fire insurance policies for your premiums. It's just part of being in a high fire zone. There are some things regarding commercial real estate as well. And like high 1031 tax deferred exchanges still is the same, unchanged. There's different things here, but I'm really more talking towards the real estate professional section. So I'm just going to jump down to here. Okay. And just to give you an overview, there are, basically, there's really great decreases for the tax rate towards corporations. And from the prior law, corporations were taxed at a 35% rate. And through the lobby efforts and, a lot of the corporations like, big companies like, Amazon and, actually, they don't even pay any taxes. Many big companies that are in America, they were lobbying to reduce the tax corporate rate. And now it's actually to 21% at the corporate rate. That's a huge tax reduction. So Congress passed this through, and we do classify ourselves as sole proprietors, independent contractors, and it also applies towards pass-through entities such as partnerships, LLCs, S corps, that get what's called a qualified business income, 20% qualified, they call it QBI, qualified business income reduction. But there's certain conditions, okay? They're trying to make it for people who have up to, I think it's what's called 157,000 or less, okay? And that does apply to a majority of us realtors, because if you're making, 5, 8 sales a year, you're probably under this threshold anyways. So the exception is that if you're a business owner, which is you, if your taxable income is less than 157,000 or 315 for a married couple, you will qualify for the full 20% QBI deduction. Okay. And so that's kind of cool to know and remind your tax preparer about the QBI deduction for 20%. Okay. So I'll show you an example in a little bit, but basically real estate agents and brokers, as long as you have below 157,000 for an individual, you claim the full 20% deduction, and that helps reduce your taxable liability by a lot. Okay. And this is going to apply prior to you taking your uh, expenses, okay, like your licensing fees, your realtor dues, your MLS dues, your Supra dues, all of that stuff. Okay. So if you have taxable income that goes above this, there's still some deductions you can take, but you get a less amount. Okay. So NAR helped provide us some scenarios, and I'll cover that really quickly. Okay. So Realtor Amy is a single agent who operates as an independent contractor. She has taxable pension income of, okay. In example one, I have to go to the example section. Hold on. There's 5 examples they're going to talk about. One is a sole proprietor and independent contractor. There's going to be example 2 that we'll talk about, and this is for people who have taxable pension income. Number 3 are a married couple, and they file a joint tax return. And number 4, this is Deborah, who has a single, and she's a high producing real estate agent, and they're going to talk about people who made over $157,000. And illustration number 5 is going to talk about Deborah, who has an employee who she pays $50,000 of wages. Okay, so let's go to number 1, who's the vast majority of us. Okay, Realtor 1, Amy, has a single agent. She received $100,000 in net income in 2018. It's the same thing from now in 2020. She has no capital gains, no losses, okay, regarding like a home sale or whatnot. So she claimed her deductions not related to her business, including the standard deduction. So her total taxable income is $81,000. Her qualified business income is $100,000, and her gross commission less her business deductions. Okay, so let's kind of figure that out really quickly. And there's also something called a Section 199A, which is your, let me show you what Section 199A is. I have another sheet for that. I'm going to share my other screen. Okay, so this is from the CAR website, and they have some links as well to help you. You could go to the IRS question and answers for some IRS language, which is, straightforward, but it's also very, the jargon they use is really for an accountant to read. But all the details of the 199A of the Tax Cut and Jobs Act is spelled out here if you want to provide your tax professional the link so that they can read up on it. Okay? So all agents and brokers are eligible for the 199A 20% deduction. Okay? So that's going to be the threshold, 157,500. And If you earn more than that, there's a phase out that applies, and your tax professional can kind of calculate that for you. It's kind of just basically reducing that 20% based upon, various tiers. And this standard deduction to reduce your taxable income below the threshold amounts, this is basically whether or not you choose to take a standard deduction or of 20%, or many of us in years past would take what's called itemized deductions. Okay, so people are asking, what's an itemized deduction? Okay, and I'll explain to you really quickly. Itemized deductions are listing out all of your business expenses that you incurred in the year of 2020 to operate, maintain, conduct your business as a professional. And you can choose easily to take a 20% deduction on your income or choose to itemize. Now, I don't know what's best in your situation, but I'll tell you, like, we can do an itemized list for ourselves, and it's going to vary based on your unique situation because I don't know what kind of expenses you've incurred. So, for example, I can give you an itemized deduction example, and then we'll see how it applies. Okay, so I just want to give you a scenario first, number one, and then we'll talk about an itemized deduction. Okay, so this is the vast majority of people is example one. Let's say you've made 5 sales in 2020. Each of those sales was 11,000 gross commission, right? So you had a net commission gross income of 55,000 that we 1099 to you. Well, technically, let's say you had a little bit higher sales because you're only responsible for what we issue to you after the broker split. So total overall, you had a 55,000 1099 received by the company. You take right off the top a business income deduction of $11,000, right? That's 20% of 55,000. I got my calculator here real quick. Let me do my math. Now, the $11,000 reflects 20% of this net commission income. If you happen to earn more than that, like $80,000, then you apply 20% times 80,000. It's very simple and straightforward. Okay, so that's one of your qualified business income deduction, the QBI. Then this example illustrates the standard deduction that they decided to take as an independent contractor, and the standard deduction is a flat $12,000. Okay, therefore, this is reducing your net commission income down to 32,000 as your taxable income, and then they applied the rate of, I got to do this backward math. 32,000 at what rate times what percent equals 3650. It's roughly, I think, 11% rate. It's 11.3-ish, 11.4. It's roughly 11.4% tax rate for this is what the illustration said. So you would pay in this scenario 55,000 gross income, 3650 for a vast majority of you guys. Okay, that's one scenario. Okay, now I want to show to you in this scenario that the $12,000 may not be your best course if you have a lot of business expenses. If you have a very low income, maybe you only made one sale, then I would say that the standard deduction is probably the best case for you. But if you do have a lot of expenses, then you have to do your math. Okay, so let's do the math together. I'm going to stop sharing my screen and show you what happens. Okay, so I'm going to bring up a simple, let me do an Excel sheet real quick. And I apologize for not doing this in advance, but I'm going to do it in front of you to show you what I mean. So it's kind of like a worksheet that we could do together. We're going to look at my Realtor business expenses in 2020. Okay, I'm going to outline an illustration of some of what's called expenses that are typical for a realtor, right? We all pay our membership to a board of realtors, right? Okay, and I'll just apply, I think we're paying, I don't know, $650 a year, right? Then we have our CRMLS dues quarterly. I think that's roughly about 120 times 4. So we'll call that $480, correct? Then we have our Supra key payment, correct? And that's $15, $16 roughly. I'm going to use round numbers for the easy purpose of our case. I believe it's like $15.80. I'm just going to do $16 times 12. So we have about $192 in Supra key. Then we have our DRE licensing fees. And I believe that's somewhere to the tune of $340 every 4 years. So 340 divided by 4 years is about $85 a year, correct? Then we have other expenses such as
car payment.
Huh?
Car payment.
Okay. We do have auto. Okay. I'm actually going to list this out separately because this portion is called Schedule C and this is called itemized, right? There's a specific section where you can go towards a business auto, and you could auto expenses, you can choose to do 2 ways. One is called actual expenses, and the other way is going to be called standard deduction. I have to look for the really quickly the rate that they give you. They give you in 2020 57.5 cents per mile. Okay, so let me go back to my spreadsheet, which is 57.5 cents per mile in 2020. So then you got to calculate how many miles did you drive. Most average American realtors probably drive somewhere around maybe 12,000 miles per year, maybe a little bit more. But in this scenario, I'll just say we drive for business, let's say 8,000 miles, okay? If I times that by 50.575 miles, that'll give me $4,600 type of a deduction. Okay. Again, this is all called business miles. I'm going to give you throughout the course of today's lesson, business miles means only towards the business. It does not include your commute to work. Okay. I'm also going to talk about business auto, but that's a little bit later. Then you got to choose your actual expenses. Let's say you have to get an oil change every 3 months. So that's maybe 50 bucks per oil change. That's going to be $200 for oil change. Then you have your gas. Okay. Let's say you fill up your gas and you spend $100 a month on gas. So that's going to be $1,200. Then you have for gas. Then you have your repairs. And let's say you maybe incur, I call it maintenance. And you have stuff like you have to do tires. To me, tires last every 3 years? It depends on how much you drive, but that's an expensive item. So I would cover this, I call it maintenance, tires, various expenses, like maybe you have to fix up parts. So I don't know what that could be for you, but let's say you average roughly, I don't know, $1,000 a year for maintenance. And then you could have other auto expenses such as your registration, license fees, your auto insurance, right? So some of us pay, I don't know, everyone has different expenses because if you have a high expense vehicle, it could be more. But your auto insurance, I don't know, most people are around like $700 6 months. So I'll say $1,400. So you can see here, if you actually make the actual expenses, you probably could end up a lot more. I'm not 100% sure if your gas is going to be included as an actual expense. So please clarify that one part. But you can see that your auto expenses probably will be larger than your standard deduction. However, your standard deduction and your mileage is the easiest and simplest way to just get that expense covered. So you got to compare, but in this illustration, just from here, it does exceed 4,600. Very close, because I don't know what your license fees are, and I don't know what other expenses you have. But let's get back to this, itemized deductions, okay? A lot of us have to do what's called signs. We buy open house sign, you buy a yard sign, you buy various types of riders on your own. And even if you just buy 6 signs here and another 4 open house signs, you're probably looking somewhere around $500 in signage a year. Let's say you do some marketing, right, guys? Now, marketing, whether you purchase zip codes from of certain websites that try to offer you leads, or whether you marketing yourself through various flyers or prints or this and that, okay? I'm going to separate that out, but I'll call it marketing and prints. So if you make color copies, or if you do any brochures and you have a designer custom design something, or you build yourself your own website, that's all marketing, right? Some of you guys pay a $30 a month. They use maybe like Top Producer, or they use Constant Contact for a CRM, and that's like a $30 per month charge. I'll just estimate, I mean, that's $360 just in itself a year when you times $30 times 12. But let's say you also have other expenses like prints and brochures, and that's another $500. I'll call that maybe all together. Let's say you put $1,000 in marketing every year. That's kind of reasonable, and probably very low if you're actually purchasing zip codes or doing an ad on a bench, or you're putting an ad on a menu at your favorite restaurant, or you purchase ads with all the just basically
entertainment.
Okay, I'll get there. Thank you. Entertainment is there. I'm going to talk about entertainment later. But you have marketing and print. I'm just going to put in here $1,000. Now you also have stuff that's going to be deductible, such as your photography. And in 2020, it was all about Matterports or virtual 3Ds and or a drone, right? A lot of agents do this stuff. So I don't know how many listings or how many you've done yourself. I've done some myself, and I had that incurred expense. I have my receipt. And so I went ahead and for example, you're doing a drone, that's about $600 to $700. If you no, a Matterport is about $600-700. Your drone's going to cost you maybe $300, and your photography sometimes like $150 for full professional photography. Let's say you had 3 of those. Okay, that's already going to amount to almost $3,000. Okay, it depends on your receipts. Now, let's say you also have other expenses in your business in real estate, such as rebates. Okay, the DRE allows a one-time rebate to a customer to your business up to $500 for that, maybe that referral, or maybe your I don't know, your cousin referred you a relative to do real estate. So if they gave you a rebate and you did $500 to that cousin one time, and maybe you had 2 of those, $1,000. Okay. There's other areas of expenses. I take a phone expense. How many of you guys use your cell phone for business? Everybody, right? We all have our cell phones. So on average, everyone, I mean, I have a really good deal because I have a really good rate with T-Mobile, but you need to know what your business expense is for your phone. And most people pay roughly $45 a month. Times that by 12, you're looking at $540 just on your cell phone expense, right? Entertainment is something that is only, I think it's 50% deductible, but they did limit the type of entertainment expenses you can do. So I'm not even going to list this out because I don't like to put it as entertainment. I would rather you expend it toward a client appreciation event, and you label that as some sort of, let's say you had a, like, here's an example. I close on my property on a transaction, and I told my customer, I'm very thankful, appreciative of your business. And, instead of giving you a client gift, like a bottle of wine or a TV or whatever that you do in your business, I want to do something special for you and your family and your friends. So I want to host your housewarming party, Mr. Buyer. And Mr. Buyer, I'm going to dedicate, $1,000 towards food and drinks for you and your family. And I just want to really appreciate and thank you. So I'll give you up to $1,000 for catering. Okay. It doesn't have to be that. I'm just telling you what you label it is important. And so $1,000 towards, maybe I had a nice meal, or I have some party favors, and I help them get maybe a nice child bouncing thing in their for all the children and the family to play around with. Okay, let's say I spent $1,000 for that. Okay. There's other expenses you can outline that's very essential to your business. And the cool thing about real estate is you can choose to what's called depreciate certain goods up to a certain amount, or I could choose to expense the item in full. So what does that mean? Actually, I did buy this in 2020. I bought myself a laptop that I use for my business. And I'm actually using it right now because I wanted to have a nicer laptop for my Zoom meetings in 2020. So I went ahead, bought myself a nice laptop, spent $1,000 on that as well, and I have the receipts. I actually bought 2 laptops, guys, but I'm just going to give you a $1,000 laptop right now. So this laptop cost me $1,000, and I'm going to choose to fully deduct this laptop. But I also have the ability to depreciate this over the course of 3, 4, 5 years if I really wanted to spread out this itemized deduction or not. But in this scenario, I'm just going to itemize this off in full. Then you have other things like your, I forgot to mention your lease payment. So you have a client appreciation, you have a laptop that you purchase. Some of you guys, like myself, in 2020, I bought myself a new cell phone, guys. So I bought myself a Samsung. For me, I got an S21. And my S21, I don't know, I think it was around like 900 bucks. Okay. And I don't want to depreciate that either. I'll just take the full deduction there. And I do use it for my business all the time. People buy some things like cameras, or in other people's, in years prior, I bought myself a drone myself. So, you know, if you use it 100% for business, then you can deduct 100% of the expense. But for me, when I reported my tax income, I actually use 50% for business, 50% for personal enjoyment. So I only take 50% of that expense to deduct. Does that make sense? Okay. So the IRS wants you to allocate a percentage use towards the business and personal use. So you need to define that and have your own evidence and records, because the burden of proof falls on you. Correct? Now let's say I bought myself some business cards, and I bought myself a magnet, business cards. I bought stationery. I bought myself a magnet for my name. I bought myself, what else did I buy myself? I bought a bunch of pens with my phone number. I bought some calendars. I bought some, I don't know, people buy all for notepads. Okay. These are all considered marketing as well. So you could technically put it under marketing if you wanted to, but in that scenario, I didn't. So let's say I put it, you know, there's so much different marketing ideas that you people are doing, but you know, this is let's say it costs you another, I don't know, 1,500 bucks. Okay. Postage. How many of you guys send out postcards or letters to your clients? Like you know, that's ordinary in our business. And if you have your receipts for your stamps, and you have I call it designs. Maybe I paid my designer 200 bucks to make me a nice postcard, and then I paid the stamps for 500 doors. So 500 times 30 cents. I had to pay 150 bucks right there for my postage. Okay. Anyway, I'm just giving you an idea illustration. And let's say my camera just cost me 400 bucks. Okay. So you can see here, these numbers easily add up. Okay. You can go on and on and on. Does anyone have any expenses that they, off the top of your head, can help me remind me? There is more. So our membership.
Fax line.
Say that again.
Fax line. Fax. Phone line.
Oh yeah. Yeah, fax. Some people have a fax line. Some people have a special, you know, you can call it voice over IP services. Some people have a separate phone line. Some people have a dedicated hosting stuff. So you can call it, electronic services. I'm gonna just call it electronic services, okay, Gene? Because I don't know about you,
Okay.
but I started purchasing Zoom software, a subscription this past year. And I'm paying a subscription, I forgot what I pay, 16 bucks a month. Okay. So Zoom by itself is costing me 192. And then I also have a fax line. Maybe I'm paying $10 a month. And that's another 100 bucks, 120 bucks. Maybe I have other electronic subscriptions. I'm gonna write that down. I forgot about that. So you have to remember, you have to tell your accountant what are the receipts and the invoices that you're using towards business. So I needed, I almost forgot about my Zoom. Because I'm actually right now gonna start preparing my taxes, and I want to make sure Zoom would fall under subscriptions, okay? But you can also just call it electronic services and subscriptions. I'm gonna write it like that. Okay. Some of you guys do Facebook ads, right? That's an expense in your marketing. Okay. So this is kind of low technically, because a lot of realtors do tons of marketing. I'm gonna say most of us probably spend more than probably $2,000 at least in that. So whatever, I just put my Zoom only right here at 192. But if you have Constant Contact or you pay for other digital subscriptions, then you pay it through here. So
what about trainings?
Education and seminars. Thank you, Nilafar. So I do pay subscriptions and seminars and various things. Like if you go to the board and you pay for a class, you have a receipt, don't you? If you go to a commercial training, you have a receipt. If you go to a big seminar like Mike Ferry or Tom Ferry, or some of us went to various different providers, we go through lots of education classes. And therefore, I would imagine a lot of us are spending $2,000 on education and seminar events. Okay. So yes, thank you, Nilafar. I don't know what the true actual expense, you just put in your own detail here. And whatever it is that you paid for training and education, don't forget, I'm also going to include continuing education. Don't you guys have to get a license renewal and pay? Actually, I don't have that because I just go through, and I just did this last month. I go through the CAR website and they give us free 45-hour credits. I went through the time, I did the electronically for all of my 45 hours, and I didn't pay a dime because of my membership includes this benefit. So I wouldn't put my continuing education in my deductions because I have no evidence. But some of you guys do pay for it and attend a Career Compass event. Some of you guys pay for it and do a outside third-party lesson provider. So if you did, go ahead and expense it if you have the evidence. Travel is another thing, and this is the gray area because if you 100% traveled for business use, like myself, I traveled to Chicago, to Boston last year. I went to Washington, D.C. to lobby at NAR. And so I did do 100% travel many times in no, it's actually in 2019, I did all that travel. In 2020, I didn't do it. But if you did have travel and you had to go visit a property or visit a customer, or you went to do some sort of, some of you guys manage and purchase property out of state, and you went to travel in order for your business, then you go ahead and deduct your airfare, your lodging, your baggage, your taxi, your so I'm gonna label all of that in here. and you have taxis or public transportation like Uber. You have other expenses like even dry cleaning could be labeled if you did dry cleaning, right? So whatever it is, if you had travel expenses and you also maybe have some meals, but I'm going to cover that separately.
What about home office expense?
I'm almost there. That's not on your itemized part, but it's kind of like your business auto. They have a home office area.
Okay.
So let's say that travel had some meals, and I also had meals for my employees, or I had meals for my clients when we went to show property and then we took a meal together. I think meals are treated at a 50% rate. Oh, hold on, let me think.
Kevin, you get fees.
No, I'm
Me-
just reading. I'm reading the new Tax Cut and Jobs Act. Prior to the Tax Cut and Jobs Act, normally we would be 50% deductible. I actually don't think they're deductible now. Entertainment has been removed. Okay. So let me show you another screen real quick that I just looked on. Remember the 2017 Tax Cut and Jobs Act? There has been an update though. So signed by the president just 2 months ago. They made changes for deductions for business meals in tax years 2021 and 2022. Businesses will be permitted to fully deduct business meals that would normally be 50% deductible. But this change does not affect your 2020 tax return. So it's 100% for 2021 and 2022. And that's why you got to stay up to date. And it's 50% in 2020. So if I took a meal, I took my employees out to eat, or stuff like that. Okay. So that's why you always got to stay current on this. And also, if you use like H&R Block or you use Tax Act or TurboTax, whatever you're using, make sure you update your software so that they have all the new provisions and changes that always are changing. Okay. Going back to the screen share, I'm gonna kind of just pause right here on the expenses. You guys see the expenses? Because meals and travel is kind of treated separately. It's on its own line item. So I'm gonna separate that out from the Schedule C. Okay. But ultimately, you do have a good amount of expenses that we've outlined it, and I wanted to give you an idea of what we're talking about. And speaking towards, for those of you who use, let's say you have a auto lease like myself, okay? And I did place my vehicle in operation in business back in 2019 when I got my vehicle. And then you have to classify how much of your vehicle is used for business and personal, like 80-20, 50-50. I don't know what you do, but you need to have that records and classification. Or for my example, I have a couple of vehicles. So I use one for personal and I use one for business. Okay. And so in my situation, I use one strictly for business, which is my more expensive vehicle, because I take clients around and I want to have a nice, comfortable vehicle for my clients to feel good in. And I don't know what your monthly payment is for your auto vehicle, but if it's like $500 per month, you're looking at $6,000 a year. Okay, if it's 100% for business use. So it's up to you to classify and dedicate how you do it. In this illustration, I'm just going to say you're using it for 100% use, and it was $500 a month. Okay. Then you have your home office expense. And here's where I want to caution you guys, but definitely don't want to say don't do it. A lot of us work from home, even myself included. I have a whole room that I use as my Zoom room. I have my office equipment, my cabinets, my desk, furniture that's all dedicated in my house specifically for working real estate and working from home, because all of us did a lot of that this year in 2020, right? So guess what? You're supposed to measure the square footage allocation of your house that is used for business purposes. Now, if you live in a 1,200 square foot home and it's 3 bedrooms, and one of those bedrooms is a 200 square, let's say it's 250 square feet, okay? Well, actually, let's just say it's a 1,000 square foot home, it's easier. So if you have a 250 square foot room and it's a 1,000 square feet house, that's 25%, right? So then you take your monthly payment, insurance, your monthly payment, your insurance, what else are you doing? You know, all basically your house payment. Okay, so it's that's basically what you're looking at essentially. But some people have like additional expenses like maintenance and whatnot. But I'm just going to cover your insurance and monthly payment. You're supposed to take that, times that by 25% to be your deduction. So if you're monthly for a 1,000 square foot home and you're paying $2,500 a month, okay, you times that by 2,500 a month times 12 years, 12 months, I'm sorry, that's $30,000. And let's say my insurance cost me $1,000 a year, 31,000. Divide that by 25%. I mean, I'm going to multiply that by 25%. That's roughly equals 7,750 deduction. Okay. So yeah, you could take that home office expense, Nilufar, and deduct that off of your income if all of this makes sense. Okay. Now the reason why I wrote a red flag is because the IRS does look into more closely people who take a home office expense, because again, everything I know you're doing is you're going to be reporting the truth, but that still basically means everyone is subject to what's called an audit. And if you take a home office expense, there are studies that I've heard from many people who worked for the IRS, whether they are a temporary worker or not, they are trained to look closer into people who take a home office expense. Because they might say, I don't believe you're using 50% of your home for a home office or whatnot. Because people try to take a larger expense, or, you know, the square footage might not be calculated correctly, or the amount is exorbitant. So therefore, if you take your home office expense, make sure you're doing it appropriately to IRS tax code. But I'm just giving you a rough example that in this situation of a 25% allocation of the home, it would be around 7,750 $750 for a monthly payment. You know, everything's all subject to what your monthly payments are. Does that make sense, Nilafar? Do you have clarity on that or not? So
Yeah,
I'm
it's
just here.
true. Mhm.
Yeah, I'm just here to point out it is a red flag because they'll look closer to it. And, you know, there's other red flags as well that I'll point out in as we go. Okay. The actual expenses as well might be a red flag. And that's why for my purposes, I don't, even though I do validly have a home office, I don't even want to take the expense because it's not worth it to me. Okay. The other portion is the mileage. For me, I just report the standard mileage, even though my lease is expensive. I'm paying $640 at $636 a month. But I'd rather just take the standard mileage deduction, even though my actual expenses is greater than that. And whether you choose your own course of action, but for me, I know the standard mileage deduction, even though it's less of a deduction, I just rather go the standard route because I don't want to raise any red flags. Okay. Now speaking towards mileage. Okay. Mileage is of the IRS allows a realtor, independent contractor to track their mileage in different types of ways. You could do, I think it's a 90-day, 3-month period of time where you track log your miles, and then you can spread it out for the course of a year. Or you can do, and whatnot, you can do other scenarios, but you're supposed to, let me pull it up for you.
Ask a question.
Yeah, I'll get you a question real quick. So someone has a question. Let me pull up your question. The question is this $12,000 for single and $24,000 for a couple off the top means that you use this deduction and then you take your expenses out? Yes. So is standard deduction is taken out the top, the 12,000. So it's standard deduction and business income 20% off the total net income. Well, what's the question?
My question is that $12,000 for single, and you calculate all these itemized items, you add this itemized to $12,000 and take it from your net.
Let me clarify that portion. That's a good question, Nilofar. Let me go back to my Excel sheet. After you calculated your itemized, Nilofar, whatever you spent in 2020 with receipts, and you can, and then you basically, you add that up. I'm not going to do the math right here, but this looks roughly 2, 3, 4, 5, 6, 7, 8, 9, 10, 11,
10,000. 10,000.
This looks closer to 12,000. It looks like it's 10,000, you said? Okay. If it's $10,000.
Pretend that is $10,000.
Okay. Pretend this is $10,000 worth of expenses. Okay. Thank you. Thank you. So you have $10,000 of what's called actual itemized deductions, right? 10,000 bucks.
Yes.
Then you compare it to the standard deduction of $12,000. In this scenario, if you have $10,000 of itemized, you're better off not itemizing and taking the standard 12,000 deduction is what I mean.
Okay.
It's not both. You can't take an itemized and take 12,000. You choose the standard deduction of 12, or you choose your actual itemized.
It's one way or the other, not both.
One way or the other way. So if you have actual expenses and evidence of $15,000, absolutely, this makes more sense than the standard $12,000 deduction for an individual. That's the point I want you guys to understand.
Second question.
Yep.
If you're single, you take $12,000 standard. And if you're a couple, $24,000.
If
Both
the
of
couple is a
24.
1099 independent contractor status.
Okay, so if one is W-2 and the other one is 1099, just use the $12,000.
12,000 would be your number because the W-2 already pays their taxes.
Yeah.
But they don't get what's called the QBI, which is that independent contractor self-independent contractor deduction, standard deduction.
Thank you, Calvin.
Good question. No, I appreciate that. I'm glad you guys are listening. So this is really where you just lay out all of your expenses and think about everything that you've done and have the evidence for, and then you can compare. A lot of people who reinvest in their business and they market themselves and have software and different tools, your itemized might be greater than $12,000. But if you only had limited sales and you maybe part-time, you're probably better off with the standard $12,000 deduction is really what I'm talking about. So that's why I said everything is dependent upon your own unique situation. I can't tell you the straight answer, yes or no, because I don't know all of your history and only you guys know that. Now, getting back to the mileage portion, this is a recent article that I share with you, that there's several options you can take. There's really two primary approaches that are good for a realtor. Okay. Let me start sharing this screen because this is important because again, you are responsible for burden of proof. So your mileage tracking deduction, your mileage is important because, we all drive for showings and going to properties and picking up clients or blah, 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 even going to classes or, stuff like that. So there's a lot of additional expenses that you incur as well. Sometimes you have to pay gas, tolls. If you're like in Irvine area, they have a toll bridge, or in San Francisco, you also have a wear and tear on your car, right? So the two approaches here we're talking about is it's 57.5 in 2020. That's what I read somewhere else. But basically, you're looking at per mile. So if you have 20,000 qualifying business miles, you can deduct roughly 56 cents, or in 2020, 57 and a half times whatever business miles you have. Or you choose the actual expense method, which is, I already told you, it does include gas, maintenance, oil changes, replacing your wiper blades, repairs, and stuff like that. But you're supposed to allocate the amount that you're using towards your business if you also use this same vehicle for personal use. Okay, so this is a faster and easier approach for standard is what I do, because I just don't want to spend the time to outline all my expenses. But maybe the years that you do your tire changes, that's probably the year you do your actual expenses. And the 2 other years that you don't do the tire, then you maybe go the standard route. I'm just giving you some suggestions, up to you. Also, if you have a high vehicle, then expensive vehicle, then it might be going towards the actual is probably a lot more beneficial to you. But the mileage portion is very important because you could track your business mileage by keeping a daily log of your driving. And per the IRS tax code, you include the dates of your driving done, your destination, your business purpose. Like I went to show John Smith on Saturday and I drove property A, B, and C, and we did 35 miles today, okay? And if you had any parking fees or tolls, okay? Then you track how many you use for business and separate which is for personal use, okay? Okay, then there are ways, this guy didn't actually outline it, but you're supposed to do it for a 90-day period, okay? It's not mentioned right here. There are apps that you can download and use in real estate. So you can just download your mileage and standard calculator, and then they can track it for you. And then when tax season comes around, you can go to your app easily and it'll have everything that you calculated. But you need to be conscious to report to your app how much you're driving for mileage. You turn it on. I'm driving for business now, and then they kind of track your mileage. So you can do that if it makes it easier for you. So this is one of the largest tax deductions you can claim. So this is what you need to have in your records: the date and time, departure and destinations, the client name and the purposes of your business and the purpose, total miles you took, any fees you taken like parking fees or tolls. And then you have to be able to justify. So the justification is, yes, you need to justify everything. So that's when you pull out your app and show them, this is how I tracked my mileage. Great. Or you can go ahead and do other types of tracking, which is a daily journal or in your cell phone. So let me show you exactly where they're talking about. Well, anyway, that's what it is. I'm not going to go into detail, but you guys know, if you did 12,000 miles in 2020, which is basically the normal for everyone, and you spent 80% of that towards business, 20% towards personal, go ahead and apply that ratio, but you have to have a journal log for 90 days. Okay, just know that of what I actually said here. And it's a nuisance. It's very difficult to keep all this track in the daily log. That's why having a journal of your business is very, very important in the small event chance that you get audited. But you can justify it when you have a detailed log. The IRS will look at you and go, wow, okay, great. You have records. But if you have no records, trying to produce records after the fact is going to be so burdensome. So that's why you just try to make a daily duty for a 90-day period to track and it could be the busiest season. Like, many people are not busy November and December because that's holiday season. So why not do the spring and summer season when you're the busiest, and that allows you to have probably more miles that you're using for business, correct?
Yeah.
All right. So that's my tip on mileage, but you got to calculate your own ratios yourself.
One more question.
Yeah, what's your question?
Last year, I didn't do